On May 1st, 2026, the United Arab Emirates walked away from OPEC, the Organization of the Petroleum Exporting Countries. 59 years of membership ended by press release. Saudi Arabia found out the same way everyone else did. By reading it, the UAE wasn't some marginal member cutting its losses. It was OPEC's third largest producer, sitting on close to 5 million barrels a day of capacity, actually pumping under 2.5 million. That gap, capacity built and mostly idle, is the whole story. For years, the UAE's OPEC quota sat around 3.5 million barrels a day, while Abu Dhabi's national oil company, ADNOC, poured roughly $150 billion into pushing capacity toward 5 million barrels a day by 2027. It was paying to build oil it wasn't allowed to sell. The UAE's own explanation was almost aggressively boring. The Energy Ministry called it a comprehensive review of the UAE's production policy and its current and future capacity based on national interest. Energy Minister Suhail Al-Mazrouei told CNBC it had nothing to do with any of the group's other members, and that the UAE holds the highest respect for the Saudis for leading OPEC. The country was not fighting with anyone. It was simply done asking permission to sell its own oil. 40 years earlier, a dominant OPEC producer faced the same math. In 1986, Saudi Arabia did something structurally similar, though the mechanics looked nothing alike. Through the early 80s, Saudi Arabia played the role of OPEC's shock absorber. While other members quietly pumped past their quotas, Riyadh cut its own output to defend the group's price. From over 10 million barrels a day in 1980 and 81, down to somewhere between 2 and 4 million barrels a day by August of 1985, depending on whose figures you use, Saudi Arabia was absorbing almost all of OPEC's discipline, alone, while everyone else cheated. By late 1985, Riyadh had had enough. It abandoned price defense and pivoted to market share. In early 1986, it rolled out something called netback pricing, a deal that guaranteed refiners a fixed profit margin no matter what crude actually cost. Saudi Arabia removed the floor on purpose. Buyers had every incentive to take more Saudi oil, and they did. Saudi output jumped from about 2 million barrels a day in August of 1985 to 5 million barrels a day within months. OPEC's total output hit roughly 18 million barrels a day by December. The price did exactly what you'd expect. The OPEC basket price fell from $23.29 a barrel in December of 1985 to $9.85 by July of 1986, a 58% collapse in 7 months. Some spot prices that summer dipped as low as $5 a barrel. Saudi Arabia's share of OPEC's total output, which had been 36% at the start of the decade, fell to around 20%, even as its absolute production climbed, because everyone else was drowning the market too. 6 months, that was the collapse. It took OPEC until early 1987 to put itself back together, with a new quota deal built around an $18 target price, and Saudi Arabia extracting a guaranteed 25% share of OPEC output as the price of its cooperation. Prices crept back above $18 a barrel by the end of the decade. The through line between 1986 and today is capacity outgrowing quota until the arrangement stops making sense to the country holding the extra oil. In both cases, a major producer looked at what it could actually pump versus what it was allowed to pump and decided the gap wasn't worth the loyalty anymore. But the parallel breaks in ways worth saying plainly, because pretending otherwise would be dishonest. Saudi Arabia in 1986 never left OPEC. It stayed inside the cartel and changed strategy from within, flooding the market to punish its own members. The UAE in 2026 did the opposite. It didn't fight for a bigger slice from inside the tent. It walked out of the tent. One is a leader rewriting the rules. The other is a member state leaving the game. The power position isn't the same either. Saudi Arabia in 1986 was the swing producer whose decisions could move the entire global price by itself. The UAE, for all its capacity, is not OPEC's price setter. Saudi Arabia still holds that seat. And the backdrop couldn't be more different. 1986 was pure oversupply economics, years of quota cheating colliding with new non-OPEC output from the North Sea and Alaska. 2026 is unfolding inside an active war. Iran's missile and drone strikes on the UAE, a partially blockaded Strait of Hormuz, Brent crude spiking above $126 a barrel in the same week the UAE announced its exit. One story is a glut pushing prices down, the other is a war pushing prices up. They are, in the most literal sense, moving in opposite directions. And 1986 has an ending, a new quota deal, a price floor, a recovery by 1988. 2026 does not. Analyst Bob McNally put it plainly, with OPEC plus discipline already loosening, the main impact will be to increase the volatility of oil prices. Nobody is promising a resolution because there isn't one yet. What 1986 does offer is a warning about what happens after a producer with real spare capacity stops taking direction from the group. Once Saudi Arabia broke ranks, the fracture didn't stay contained. It took a year and a global price collapse before OPEC found a new equilibrium. Analysts are already naming Kazakhstan and Nigeria as the next members whose actual output has drifted furthest from what their quotas allow. Nobody knows yet whether the UAE's exit is the whole story or just the first one to leave the building. What 1986 suggests is that once one major producer decides the math doesn't work anymore, it rarely stays a private decision for long.